Hello, everybody, and welcome to another podcast with Investing Education Academy. We have some fun for you all today. We're going to talk about past recommendations, stocks we talked about, investments that we've mentioned. Some of you all have, you know what? I'm not going to give it away. Leon's going to tell you why we chose this topic. I'm going to do a little bit of housekeeping.
Yes. So, so like you said, today we're going to cover pretty quickly some past stocks that we mentioned. Um, disclaimer: doing research. None of this is our actual recommendations. These are just educational purposes only. Are things we've recommended in the past. So, sorry, not recommend things we talked about in the past. So we're going to talk about some stocks that we've pointed out in the past that we suggested our community actually look into. Now, the reason this is important is because the whole point of IEA, the whole point of investing, the whole point of just as the investing universe is to make money, right? Is to have your money work for you. And if you don't put your money to work, your money cannot work for you. And
Well, Leon,
yeah.
when you say not putting your money to work for you, let's throw some examples out there. Like, what would you, Leon, the options guru, consider a person not putting the money to work for them? Like, give me a scenario.
Oh, the number one scenario is what a lot of people do. Not having your money working for you is having your money sitting in a bank, collecting far less than 1%. Even if your money is sitting in a CD or a high interest rate bank account, you're probably collecting less than 2%, maybe a little over 1%.
And for those of you all, jump in.
Mhm.
We're gonna do a little tennis right here.
Yeah.
For those of you all don't know what a CD is, it's a certificate of deposit. They're often purchased at a bank, and the reason why people purchase them is because they're guaranteed to pay you a return. Notice I went like this, but I didn't do air quotes, and the reason I didn't do air quotes because it is fact, it is guaranteed. But no matter what the guarantee is, all guarantees are only as good as what's backing the guarantee. So although somebody says something's guaranteed, it doesn't make it true. Because what happens if the guarantor is gone? So I mean, but it's a whole nother
Yeah.
discussion. For
Yeah.
those
Yeah.
of you all who heard CD, certificate of deposit.
Certificate of deposit. Yeah, good point. Certificate of deposit, and it has an associated interest rate with it. And typically they're higher than banks, right? But
They're
they're
hiding the
still,
savings account.
sorry, higher than savings accounts, yes. But again, they're way under typically with the 10% that the market returns. So I would say things like CDs, savings accounts, checking accounts. Some people literally keep cash in safes in their house. Literally, I know at least one person that does it.
Well, I
Um,
also okay, this is where we have fun, right?
uh,
Almost everybody who was alive during the Depression keeps cash. They're in a floorboard. It's in a wall somewhere. It's like some secret passageway in the dresser. But almost everybody alive during the Depression keeps cash.
but
Now,
I would say even some after that, even some like born in like after World War II, still 40s, 50s, still kind of have that mindset.
yeah, well, that too, because it's what happens if the world goes to,
Yeah, World War II, right? Yeah.
and so I think the next generation of people who keep cash are those who, well, I think the next wave was pretty much those people who were like, well, what happens if technology like takes over and they, a digit or a virus hits and I can't get money out of a bank account. And especially those people who were kind of alive during, not alive, but following the news during the bank run, like that. No one knew how wide it was spread and how quick it would. Right, that became a group of people keeping the cash. And I think now it's just a question like, I don't know what's happening in the world, the uncertainty of the world.
Mm-hmm.
So people are keeping cash, but where Leon is going to keep going is there's a consequence to that, and he's talking about that consequence now.
Yeah, absolutely. Yeah. So I mean, and also trade offs, right? Like if you like if and our biggest thing is you have to be able to sleep at night. That's the number one thing. You have to be able to sleep at night. And yeah, putting your money into the market, or putting your money into some investment, you cannot sleep at night. By all means, keep your money in a savings account, checking account. But just know, at the same time, you're literally losing money every day by the cost of inflation. So that's kind of the opportunity cost loss if you have your money not working for you. So what we want to cover today, real quickly, is just some stocks that we recommended 5 months ago in May. Not recommended stocks we talked about 5 months ago in May.
And okay, and so this is not legal advice. This is not
yes.
financial advice to anybody in particular. You know, everyone's suitability is different. These are stocks that we paid attention to, some of which we've invested in, but we've mentioned them on our podcast. So if you're jogging right now, if you're watching us live, if you're in the gym, and if you're driving in the car and you listen to us with the kids, understand we're not saying stop the car and go buy the stock. We're simply saying these are stocks a few months ago we said you should pay attention to it. And for lack of a better way to say it, we're going to tell you what happened if you didn't listen to us. So, all right, well, let's dive in.
Right. So May of this year, we recommended, I think, 4 to 6, maybe a little more total, but I picked out 3. And to be clear, not all of them are up since then. Some of them are actually flat to slightly down. Nothing's down hugely, but some of them are flat, slightly down. So just, to be clear. So the 3 I picked are the first one is a company called Arista Networks, ticker symbol ANET, ANET. Now Arista Networks, just since May of this year, is up 61%, 61 in 5 months. And the reason it is because what Arista does is they're basically, for lack of a better term, they're the AI networking company. Of course, everything is AI these days, but they're legitly the AI networking company. Their 3 biggest customers, if I remember correctly, are Microsoft, Meta, and I think Google for their data centers. So they have a lot of what they call the hyperscalers or the cloud providers. They have a lot of business from them. And right now they're spending, I mean, we've talked about before, hyperscalers are going to spend upwards of $500 billion with a T, $500 billion over the next 3 to 5 years on this AI upgrade. So ANET, Arista Networks, is benefiting hugely from it because, again, once they rip out all the old CPU servers and put in GPU servers or AI chip servers, all the networking gear has to change too. And that's what ANET does, Arista Networks does. So they're up 61% in 5 months. And remember what we just highlighted, something like a CD, you may get 3%, 2-3%. Checking account, savings account, probably get close to 1%, maybe a little more. We're talking 61% in 5 months. So that's ANET. So these companies you may not have heard of, which is a good thing because that's kind of our job is to bring to your attention stocks that can do returns like this that a lot of people don't necessarily know about.
And for those of you all who are like, what does that really mean? Granted, we don't think it's going to continue with this rate, forever, but just conversationally, at 66%,
61.
61?
Yeah, 61%.
At 61%, your money is doubling every 14 months, maybe 13, 14 months. So every year, let's just go low. Every year, your money is almost doubling. So, okay, why does that matter? What are we comparing it to? And then a CD, let's say you're getting 2%. Every 36 years, your money will double. Let me say it again. In this particular investment, not all investments return like this.
Right.
You're talking about your money doubling about every 13, 14 months. In a CD right now, some CDs, not all, you're talking about your money at 2%, a CD at 2%. Your money's doubling every 36 years. So how many 36 years do you have in your life expectancy from this point on to wait for your money to double? Let's have a very real conversation. If you're in your 40s, that means your money's not doubling until you're 76. You're not going to see your money doubling. And that same person who maybe did something different, they may invest now at 40, and then at 41, their money doubled already. Your money won't double until you're 76 years old.
And likely close to being on the way out, sadly.
Yeah, this is talking like you didn't have any health issues, you didn't have to liquidate your account.
Right.
So when people hear these, I think sometimes they don't think about it from a life expectancy rate. They just think, oh, well, it's safe. Is it safe to wait 36 years for your money to double?
And when we're giving a little example, your money literally could almost double in about 5 to 6 months. Now, again, like Brent said, we're not expecting Arista Networks to do another 61% over the next 5 months. That likely is not going to happen. However, Arista Networks constantly outperforms the market, which does 10% on average. Arista Networks does on average double that, maybe 20, maybe a little over 20% on average over the last 3 to 5 years. So, if you haven't gotten it, if you've never got it in May, you've probably missed a 61% return. But that doesn't mean the stock is done. I mean, this whole AI build out thing is going to go on for the next. They're estimating through like 2030, next 5 or 6 years. So just I would say check out Arrested Networks. It's not done. It's not over. It has run up recently, like a lot of the AI stocks. So maybe wait for a pullback if you're that type of investor. If you're not, I would say it's one to definitely check out. Second one is a company called ServiceNow. Again, a lot of people may not have heard of this, but ServiceNow is an enterprise software company, and they specialize primarily in like process flow, process automation, for large companies.
And then when you say what was the word you used for enterprise?
Process flow, automation.
Process flow. When you say process flow, what is enterprise process flow? What does that mean?
Oh yeah, so it's just so how companies, when they're designing products, when they're designing their internal processes, maybe they go from product design, product development, product distribution, things like that.
Like how product placement, all that stuff.
Product, like how a company's process flow internally goes from maybe concept to actual product, and then all the stuff in between that. So that's ServiceNow. So since May, ServiceNow is up 28%. 28% in 5 months. Again, remember, stock market on average does 10% in 1 year. Now, again, like we said before, we don't expect ServiceNow to do 20% over the next 5 months, but it might. Who knows? We have no idea. But we're talking about 28% return relative to savings account, 1%, maybe less, CDs, maybe 2 to 3%. And there's not. I mean, even bonds now. Bonds before the Fed cut rates were up around 5.5%. Now they're down around 3% because the Fed is in the midst of cutting rates. So the stock market is looking way more attractive now because the rates are coming down because the Fed is cutting rates. So
that inverse relationship kicks in.
Right. So
for you all, I want to give the numbers to it. So you say 26, 28% in that range.
Yeah. Mm-hmm.
You're talking about your money doubling every 2.7 years now. Okay, why does that matter? Because again, in the savings account, you're talking about your money at savings account at 1%, your money's doubling every 72 years. So let's say you put your money in so it's safe when you were 13 years old. You still wouldn't get your money to double till you're 80-some years old. I mean,
the money right now would be half. It would be up 50%. You still have another 40 years for it to double.
Yeah, you're talking about being 85 years old before your money double.
Right.
So, in an investment like this, again, we're not saying it's going to continue at this rate. We are simply just kind of oversimplifying and making it a little more in your face so people can digest the reality of it's not just about interest rates or your money doubling. It's about your life expectancy. And so now you're talking about your money doubling every 2.7 years, roughly. Again, just play along. It's going to stay like this forever. Your money doubles every 2.7 years. If you're 40, by the time you are now 43 years old, you have doubled whatever you put into it. And that's in the best case scenario.
Right. Mm-hmm. And I think it's a good example to do the whole life expectancy thing because it puts it in perspective. Yeah, 61% return. Woohoo! But what does it really mean? And like Brent said, your money will double almost every year. Your money would double, maybe a little more than a year. With ServiceNow up 28%, like Brent said, your money would double.
2.7.
How many years?
2.7.
2.7 years. Yeah. So I mean, this is how you can accelerate the gain of your money. And also, if it's not about you, maybe in your 50s, 60s, or whatever, think about your kids. Think about your grandkids. Think about your siblings, your cousins. How this money can be handed down to your family and have the term we always talk about, generational wealth. Finally, especially for minority communities. So, all right. So that's ServiceNow, and then the last one, some of you may or may not have heard of. It's Eli Lilly. Eli Lilly is a massive healthcare company. The reason I picked this company out is because typically, healthcare is a very slow, dodgy. It's. I mean, nothing's guaranteed, but it's pretty steady. So you can typically get anywhere from 3 to maybe close to 10% per year in healthcare companies, healthcare stocks. Well, Eli Lilly this year is moving like a tech stock. and it's primarily because of their weight loss drugs. So a lot of people have heard of Ozempic. I think theirs is, I may be saying this wrong, Wegovy, if that's theirs. I'm not sure about the actual names, but they have a weight loss drug too, and these things have taken off like wildfire. I mean, it was so bad that the only time the federal government allows patented drugs to be made by other companies that don't have the patent is when there's a massive demand and short supply. So up until I think recently, the last 6 months, generic drug makers were allowed to make these weight loss drugs, even though they're under patent by companies like Eli Lilly, because the demand by the public was so high. Eli Lilly couldn't meet demand. Eli Lilly is now pretty much caught up to demand. I think those generics are going to start going away. But that just shows how huge the demand is for these weight loss drugs. And Eli Lilly over the past 5 months is up 23%. So more than double the market, and like more than triple, maybe even quadruple what typically healthcare stocks do. And go back to Brent's point, what would 23% be? How long is your money?
You said 23% or
23% is the return of Eli Lilly. Yeah. What would be the doubling for
3.1 years?
So 3.1 years. So, again, even if you're in your 40s, 50s, that's still a good return of your money doubling over the next, say, 20 years. Versus, again, if your money's in a savings account, 1%, 2%, you're talking about 70, 40 to 70 years before your money doubles. And just to kind of, again, put this in perspective, the S&P 500 over that same 5 months since May is only up 14%. So each one of these stocks is up no less than double the S&P 500, which is our benchmark over the last 5 months. Now we're not knocking 14%. That there's nothing wrong with that whatsoever.
Not at all.
No. We're just saying that's our benchmark. That's what we compare everything to. And these stocks are double, triple, quadruple. That return, the S&P 500 return in 5 months.
And I did, just for fun, I added up some of those returns, like a 60+% return, a 20+% return, another 20+% return. Just divided it by 3. That's going to give us 39%. Like, again, very rough numbers. So what does that mean? Let's say the aggregate of all the things Leon just named got you to 39% rate of return. You're talking about your money doubling every 1.8 years. Let's just say 2 for just make general ease. If your money's doubling every 2 years, the next 4 years, your money to double is now doubling.
Right.
So now if you went from 100,000 to 200,000, 2 more years later, that 200,000 is going to 400,000. 2 years later after that, that 400,000 is going to 800,000. 2 years after that, it's going from 800,000 to 1.6. So now let's take a person who has a savings account or a CD. Let's say you have that beautiful CD, you're safe. That means that your money, your $100,000 that you put into it, just using numbers, is going to turn into $200,000 when you are about 70. What is it? Would say 36 years and you're 40, 76.
So it doubles in 40 years.
Yeah.
Versus doubling every
36 years.
36 years doubles every 36 years. Say now you're in your 40s versus doubling every 2 years.
Yeah, so you think about that. If you're 40 now, it's doubling every 36 years. You're going to be 76 years old. And the person that is maybe invested a different kind of way, they might be in the next 10 years looking at 1.some million.
Right.
Again, this is overgeneralization of the market, and we're very clear about that. We're just simply saying if you're not in the market, you don't even have the opportunity for these types of returns. But the market has risk, right?
Absolutely.
I personally, and Leon, I haven't even talked to you about this, but I met with one of the Portfolio Panthers, which is a group within IEA. They said their account, since they've been with us, is at 78% rate of return, right? And they were like, I couldn't believe that it was at 78% rate of return because there was so much red in their account. And that's when we talked about it. And the reality is, when you have a very well diversified portfolio, you're going to have red. So we're not saying by this account today that the market doesn't have stocks to go down. We're simply saying that if you diversify your portfolio and it's well placed, the companies that are down are, number one, cyclical, because they're probably going to at some point be up. but let's say they just stay down. You're more than likely, with a well-diversified portfolio, have far more stocks in the green than you would the red that will outweigh the risk of being in the stock market versus the safety of being in this bank account, in this certificate of deposit, in this bond, or whatever it might be. Unless you're doing bond laddering, that's a whole nother thing.
Yeah.
It's, you really just need some exposure to something that's going to hyper accelerate your growth. And as Leon said in the beginning, you want to make every dollar you have your like a new employee. Every dollar you have is a new employee. And if it's not for you, then maybe you're doing it for all the people Leon named earlier. Again, I'm really just echoing everything you said right now because it was all on point. So things to think about.
So just to do another recap. So we talked about Arista Networks. It's up 61% since May of this year in 5 months. ServiceNow is up 28% in 5 months since May of this year, and then Eli Lilly is up 23% in 5 months in May of this year. And as Brent said, if you just average those together, that's roughly a 39% return on average over the last 5 months. From these three stocks. And like I said, I picked these from the stocks we picked in May of this year. Not all of them are up. Some of them are actually down. So I mean, we're not trying to say we're gurus. But I picked out kind of a high end, a moderate, and kind of a low end. And even the ones that are down, we're down no more than I think 5 to 6% from May of last year, from May of this year to now. Down 5%, 5 or 6%. And as Brett just said, you're going to have negatives. You're going to have red in your account or negative returns in some stocks. Nothing's perfect. But if you're even down 10% in two stocks, but you have 61%, 23%, 28% in these three stocks in your portfolio, you're still out. You're way ahead.
Yeah. If you just invested for 1 year, you probably would be travel the distance of being in the savings account for 40 years.
Yeah, literally.
That's insane. But anyway, some people like savings accounts.
Yeah, that's how quick these returns can accelerate the returns of your money. Like Brent said, if you're sitting in a savings account versus stock market, you've accelerated your gains by like 40 years in 1 year. And again, we're like Brent said, we're trying to put it in kind of easy to understand terms. I think the way you put it really around life expectancy is crucial, because to think you have $100,000 and it'll take 40 years for that to double to $200,000 versus that same $100,000 in just 5 years can go to $1 million.
Yeah.
When it's at, 40-60% return. So just something about. So again, the point we did this is that when we do suggest stocks that you look at, revisit, research, these are the type of returns you can get. And if you're not, you're just leaving a lot of money on the table. And again, this is the whole term passive income. This is passive income, right? Just put your money in, again, whatever you can afford, if you can, and just let it ride. Let the market do its work, and you can see returns like this.
So we owe you all two things, and that's stock picks from today's live. And if you all have questions about what we said, please, we urge you all, when you're watching these lives, put it in the comments. We'll answer it as we can. And then sometimes we come back to them and we'll answer questions that are posted later on, again, if we can. But no, we do this every 2 weeks. So get ready 2 weeks from now. Like, have your questions like on a sheet of paper, ready to go, fire them off. We're happy to answer them. If you're listening to the podcast, you can go to IEApodcast.com and actually leave a comment. We'll do our best to get to it. But more importantly, try. And if you're a person that's like, ooh, I don't know about this market, start with an amount that's so low it wouldn't change your life if you lost it.
Yep. And
if you're like, you know what, I just need somebody in my corner, join IEA. Investing Education Academy is a platform full of people who are investing enthusiasts. Our whole goal is to demystify investing as it relates to really stock market, but we talk about cryptocurrency. We're talking about entrepreneurship. We're talking about, the other aspects of some aspects of real estate and business ownership. And I don't mean like not entrepreneurially, but like investing, like VC type investing in some of these companies. These things are ways to turn your money into your employees. How long do you plan on working for your money? I don't know.
And we're right. There's nothing wrong with working for your money, but at the same time, you should have your money working for you also. It should be it should be dual. It should be double.
What Leon said. Again, I'm echoing what Leon said. Today's message is what Leon said. So, Everybody, we thank you all for being with us. If you are interested in joining Investing Education Academy, you can go to www.IEAmembers.com and we will go from there. Have a great day, everybody.